Policy and Profits. I'm Anthony Esposito, founder and CEO of Ascalon 6 Capital. I am not joined today by my partner, EJ Antoni, Chief Economist at the Heritage Foundation, but I would like to spend some time on the profit side. We'll get back to policy next week with EJ. So we're in the middle of you can call it whatever you want, a gamma squeeze up, a melt up, a absolute bubble, however you want to explain this market, you can. Every time we start to see a red stick during the day or a little bit of a downtick, or miraculously we get a tweet from DC, the White House, President Trump, Secretary Bessent, Iran, something comes out to push the market higher, and there's an incestuous appetite for AI, for tech, for semiconductors. The numbers are astronomical. We are at all-time highs as far as the Case-Shiller PE. The last time and the only time in the market's history we've seen a Shiller this high was 1999, heading into the tech bubble. I continue to say that. I will continue to say that. In my opinion, we can obviously run higher, but we are way ahead of our skis at this point. A couple of stats for the market, and I am going to be a little bearish here, fully acknowledging that the market can stay irrational longer than you can stay liquid. I get it. I'm in it. I'm trading it every day, managing the portfolio through. It is difficult. It is difficult to understand why and how. Prices are higher. Prices are higher. That's it, right? As far as some stats, this is the first time in history as of today that we've had 4 consecutive record highs on the S&P with negative breadth. What does that mean? That means that the market continues to run higher and higher with less and less names moving the market higher, right? So if you look at the S&P and you look at the Mag 7, you look at those AI names, we're literally running on those 7 to 10 names in tech. And those 7 to 10 names in tech are accounting for 50% plus of earnings growth, 50% plus of market value. That's not healthy. That's not where we want to be. Can it continue? Sure, it can continue. Does it end badly? It does end badly. And there's not a bull. The pontificators on the bull side that were kind of crying and sucking their thumb in March are now, tied up, ties tight, and talking like they always knew it was going to be okay. This does not end well. It may not end tomorrow, but it will not end well. If we scroll down a little bit, we talked last week about the AI spend, the amount of debt being issued, and basically how precise does that debt issuance and that spend need to be to make this CapEx in the AI world to get to a point where the prices are actually warranted for the CapEx spend. So there was a piece out of the Financial Times today which showed what the expected return on investment is for the Amazons and the Microsofts of the world. So based on the current spend, we have a negative 9% return for Microsoft, a negative 15% return for Google, a negative 28% return for Meta, a negative 35% return for Oracle. The only one that looks positive as an ROI on the current spend is Amazon at a plus 7%. The amount of debt being issued, not only in the US, but globally, we showed this last week, is astronomical. You're talking about hundreds of billions of dollars. There are leases being paid for properties, for power plants that aren't even constructed yet. There's debt underneath an equity bubble in the markets. You could easily argue about valuations in equity prices. So we have a debt bubble growing underneath an equity bubble. And then we have expected ROI negative. It does not end well. Again, it may not end tomorrow, but it's not going to end well. The last point that I'd like to make here is, I'm going to scroll down, and we're looking directly at, what's that other interesting point we had? Out of the money calls. So out of the money calls on leveraged 2 and 3 times ETFs are at an all-time high, close to $70 billion in value. So I just want to put in perspective what this means. We have people running into not only zero data expiration calls, but calls in leveraged ETFs and leveraged ETF products in individual names. So if you were to go into NVIDIA long, NVDL, so not NVDA, NVDL is an ETF that is 2 times levered NVIDIA's value. It trades at about half the price of the stock, and you get twice the exposure. Sounds great, right? However, understand that for every dollar you invest, the ETF issuer has to create shares for you, and they're going to create shares worth $2. So every time you buy, you're buying double through the ETF company. That is jacking up the prices. These call options and the investment in these levered individual name ETFs are off the charts. They're new products. They're creating vol in the market. And what will happen is the way up seems great. On the way down, remember, every dollar you sell is $2 sold by the ETF company, right? So you're actually leveraging on the way up, and you will leverage on the way down or delever on the way down at an exponential rate. That is why these drawdowns were, and will be so aggressive and so damaging when you least expect it. If we look at a name like we can look at NVIDIA, we can look at Micron. Micron year to date is up 240%. The 1 year return is 927%. I would ask you, what on earth did the analysts not know a year ago and 6 months ago that they know now? Think about it. What changed in the world that quickly that Micron over the past 5 months went up 240% with a PE of 45? I don't know what could have changed other than momentum, FOMO, and this tech AI story that may or may not be true to some degree. I want to shift gears. I want to go to a chart that I pulled up, very basic chart in the semi-holders, SMH. So if we look at the semi-holders, I'm going to pull up mine right here. Since the bottom of the tariff conversation last year, the semi-holders ETF is up 259%. Since the lows in where were we here? Since January, we have the semi-holders up 70%. Okay, these are massive moves for a semiconductor ETF. Now, what I want to notice here, I want you to notice the negative divergence between price and momentum that's developing. Again, I'm not saying they're crashing tomorrow, but they're already flashing a warning sign, as they should. If you look at price in the upper panel, you have higher highs, meaning we peaked at, let's call it 580, consolidated lower, and now we peaked again above 600, around 612. As we did that, momentum indicated on the middle and lower panel, basic, MACD, and RSI, those momentum indicators were lower, meaning the push to higher price was done so with less momentum, less enthusiasm, to put it very bluntly. These momentum indicators are very useful. I personally like to use them to find these divergences. I look for divergences all the time. Now, our basket of assets here at Ascalon 6 are very limited. Our basket of assets here are a basket of 5 futures contracts. Those futures contracts are the S&P 500, the Russell, gold, crude, and front month VIX. That's fine. When you look for divergence, you look for either prices going up as momentum fading, meaning at some point price will catch up to momentum and drop, or you look for prices starting to bottom out or get hit lower lows as momentum's increasing, meaning those lower lows are being hit with less of a push down. In this case, this is negative divergence, momentum's dropping, prices continue to rally on air. It is a red flag. It is a warning sign. Be careful. The bottom line is this, and I've been in the markets for 30 years. What we used to have was a market of investors and institutionals like hedge funds, pension funds, money managers. And on the fringe, we had gamblers. We had prop traders, we had day traders, we had guys coming in and coming out. It feels to me like the market has now shifted, and what we have in the meat of the curve are gamblers. We have 0 data expiration options. 60% of options flow, 0 data expiration. That is simply a bet. That's not speculation. That's not trading. That's not fund management. That's a bet. We have all of the Kalshis of the world and so on. Prediction markets. CBOE wants prediction markets in. NYS wants prediction markets in. It is a bulk of gamblers creating chaos. And then on the fringe, we have investors. That's how I feel. That's how it looks. If you don't believe me, go out on X. And my feed is pretty professional. At CMT_Antoni is my tag. Please go out and check it out. Go out on X and take a look at all the memes, all the trading memes that are out there, all the posts that are out there. It is becoming childish. It really is. It's AAA ball. I found one to prove my point. I'm going to play this now. This is apparently somebody that trades the market. This is the competition for Ascalon 6 in the capital markets currently.
When I'm trading, I do actually wear this ski mask because I need the market to know that I'm here to take his money. People ask me all the time, they be like, hey, why you got that ski mask on? Like, girl, ain't you high? No! I'm taking the market's money! Take that, SPX!
I like a lady screaming in a pink ski mask as much as the next guy. However, this is an institutional market. This is the most developed capital market in the world. If that's the competition, if those are the people that are jumping in and jumping out, yeah, it's no wonder that we're in the middle of a bubble. It's no wonder things are chaotic. Just be aware. Just be aware. This doesn't go on forever. Be careful. Hedge yourself. Reduce exposure. Just be smart, because this market is one that could continue to run. Look for the red flags, because when it ends, it will end badly. History repeats itself, and we are in the middle of a pretty nasty story developing. Thank you guys very much. Until next time, I'm Anthony Esposito, founder and CEO of Ascalon 6 Capital. You can check me out at CMT_Anthony on X. You can go out to Ascalon6capital.com, and you can feel free to email me at anthony.esposito@ascalon6capital.com. Thank you.